Thank you all for being here. Again, I do appreciate you spending your part of your Friday evening with me. And I really wanted to do this. I mean, this is I was just saying to someone earlier, this is the last Friday in October. This weekend is the last weekend in October. So like the year is really flying by. And so I wanted to, I want to meet with all of my clients, but I also just before that, before scheduling meeting, just kind of wanted to get one platform together or one session where hopefully people can attend, or at least I can share some of this information with them after, because we really need to start putting some ducks in a row, for a lack of better words, before the end of the year. And even though it is almost November, we still have time to get some things done. So that's part of the reason why I wanted to do this. And then also, I have been with the clients that I have been meeting with so far, I've been noticing a trend in terms of just kind of a lot of maybe anxiousness and frustration, and confusion even around what's happening with the taxes, trying to catch up at the end of the year. I'm not going to get into this in depth, but this being an election year and certain things are going to be coming up and changing regardless of who is in office. And so there's a lot of different things that we want to pay attention to as we're approaching the end of 2024 and getting into 2025, which even in itself is crazy to say. Um, okay, so in case you didn't know, and it is on the screen, we're going to be talking about how to avoid some of these hidden tax traps. And I coin it that way because we sometimes we don't know we're in a trap until either we're heading into it or we already there. And so I want to kind of give some guidance and some forewarnings, and some also some reminders of things that we can be doing in preparation for our own individual situations. Everyone's situation is different, but I really put some time into putting together some of these strategies that'll really be applicable for everyone, or at least the clients that I work with, or people who are interested in having a tax advisor on their team rather than someone who's just kind of giving out blanket strategies, or someone who's just kind of preparing the returns. So with that said, um, and I'm just curious in terms of like those who are, either listening or who will be listening. Um, how many people would like to have like a money tree in their backyard? Like, you go outside, you kind of shake the tree, all the money falls down.
Me, me,
Wouldn't that be
me.
awesome? Yeah, that would be awesome, right? Um, and even, along those lines and thinking about it, like when we're thinking about money, although that saying is like money doesn't buy happiness, but in my opinion, money buys pizza. So it's kind of like the same thing, or it kind of correlates to the same thing, in my opinion, right? And so as we have a little couple chuckles and kind of lighten the mood because we are talking about taxes, a lot of what I'm going to be addressing today is money, and then also how that relates to taxes. Because one thing that we all have in common is that we are paying and filing taxes. And so, what we want to do is make sure that we have a better understanding of what we're doing so we can do it better and really hold on to more of the hard-earned money that most of us are that we're all making. Instead of us working harder for the money, it's time for the money to be working harder for us, and that's really what we're going to be getting at, and kind of the tips and tricks that I'll be sharing relating to that. And so even as we're talking about taxes and going back to some of the consultations that I've been having with clients, I think a lot of times, and even with in conversations that I have with people, like when I say like, I'm a tax advisor, a tax strategist, or even if I get into general conversations, I think the one thing a lot of times that's not understood is the difference between having a tax strategist and understanding that tax season is not just January to April, but understanding that if you're really going to be paying attention to your money, if you really want to be maximizing what you have, tax season is all year round. And that's not to say you have to be worried about tax season all year round, but it's more so understanding and having a plan in place so that you can be prepared. You're being more proactive versus reactive as it relates to your taxes. And that's a really important thing that I hope everyone kind of receives as a part of this. We're really trying to be, not even trying, we are going to be proactive as it relates to our taxes and our finances, because it all ties together. So with that said, and kind of again going into what I'm talking about relating to having a plan, once you start to look at taxes as a tool rather than a burden, you really start to see the opportunities that are associated with having a true tax plan and actually having a partner with you in this tax plan on your team. Once you start to realize that taxes don't have to be a headache that comes around every few months, but really something that you're looking forward to in terms of, okay, and it takes me back to some stories that I have from clients that I would work with, where literally when tax filing season came around, it was kind of like a game of, okay, let's see how close I got to breaking even this year, or let's see how much I can get down my tax liability, or how much I owe, or how close I got to getting a refund. Because a lot of times, especially if you're approaching taxes in the right way, getting a large refund isn't always a great thing. I'm not saying it's not good, but we don't always want to get a large refund at tax time. And I say that because who wants to give the IRS, the state, the government an interest-free loan? That doesn't benefit you. I mean, it may benefit them, but that doesn't benefit you. And so that's the whole reason why we have tax strategy. That's the whole reason why we're planning for things and making sure that we're putting things into place. So if you do happen to get a larger refund, or if you do happen to get more money back, it's mostly because we've put certain things into place. So you qualify for certain credits, or you maximize certain deductions to be able to get more of the money that you have already paid back into your pockets. You can actually utilize it for whatever it is that you want to do. If it's going on vacations, if it's making more investments, if it's whatever it is that you want to do to empower yourself, you have the flexibility to do that. So again, in terms of talking about your tax strategy framework, when we're working together, at least with the clients that I'm working with, you're developing an empowerment behind finances and money and your taxes. It's not necessarily, again, looking at it as a challenge or a burden. Having more control over your finances gives you the flexibility to do what you want to do. We've all heard about financial freedom. I like to also add to financial freedom in terms of time freedom and location freedom, because that's real freedom, where you have the money to be able to do what it is that you want to do, but then you also don't have to be in a certain place. You can be anywhere in the world and doing what you want to do, because you have that flexibility and you have the time in which to do it. And so that's true freedom. Why this prompt keeps coming up? That's true freedom when we're talking about from a financial standpoint, and even just a personal and emotional standpoint, a health standpoint, right? So starting to build that ladder, or put that into place, a lot of times starts with your finances, and you can't talk about finances without talking about taxes. So that's part of the framework. Again, as I've mentioned previously, taxes are an opportunity for growth. Taxes are a way for you to be able to leverage what you have. A lot of times when we're talking about tax strategy, it's not necessarily things that are going to impact you right now. There are things that will impact you later on in the future, and I'm going to go through some of those strategies a little bit later in this presentation. But one of the things that in a mindset shift that I think a lot of people should practice or start to begin to practice is, okay, are you in for the short-term game or the short-term game or the long-term gain? Meaning like, okay, are you wanting things just to kind of happen right now and kind of satisfy that initial itch? Or is it more satisfying to have something that's going to benefit you later on or for a longer period of time? And again, as we talk about the long-term gain, a lot of that is in terms of how you're structuring and how you're handling finances. And then just all associated with that in terms of the long-term gain is long-term gain, excuse me, is
Now,
oh, sorry, what? I thought I heard something. Oh, hold on. Yvette, I'm gonna put you on mute for a second. Um, Sorry. So, what was I saying? Oh, about the long-term gain. So when we're starting to focus and really lean into working on long-term gains, that's how we're really building wealth. And for I'm sure everyone on this call and everyone who's going to be listening, aren't we all after the generational wealth? Aren't we all after being able to build wealth now and then having that long money, as we've all heard, having the long money to be able to pass that down and have that continuing to grow and flourish. We set the foundation for that to be able to happen down the line. So again, all of this stems around how we're starting to think about money, how we're starting to put those plans into place to be able to achieve these things. So um, continuing. So I mean, hopefully, if you're listening or if you're here right now, if and this is part of the proven path that I've put together in working with various clients to be able to help them to achieve this. And so I hope everyone that's here or again who would be listening, if you were able to walk away with your own tax strategy framework to be able to achieve what you're truly wanting for you and your life, that would make this Friday night um, in terms of coming here to talk about taxes and money all the more worth it, I hope. So with that said, while before I jump into, I don't know why it's not moving. Okay, before I jump into what some of those strategies are, for those that may not know me or for those who may not be familiar with me, my name is Lorraine Millington. And sorry, I'm just letting people in. I'm trying not to get distracted. For those who may not know me, my name is Lorraine Millington, and I have been working with and around money for the past over 15 years as either as a business owner, as an investor, and as a tax strategist. And one of the most important things that I have learned during my career around money is if you don't get serious about your money, you will never have serious money. And so that is one of the things that I want everyone to keep in mind as we're going through all of these different strategies and all of these different mindset shifts that we really want to start to um, either start to employ or either start to really make our way towards as we're improving not only our finances but ourselves in the process. So remember, get serious about your money. Never have serious money. Okay, that was like a mic drop. Okay. Anyway, let's so I also find it helpful to kind of bring some reality to some of the information that I'm sharing. And so as I was thinking about doing this presentation and providing this information, it really made me think again, and as I've mentioned a little bit earlier, some of the experiences that I've had more recently in working with clients. And so I'm going to talk about one of the client experiences that I've had recently. I'm naming, this is not this is a real client, but this is not the real client's name. So for all of those who may be wondering about privacy and all of those other things, this is not this person's name. And I have just, changed around a couple of things just to get the point across, but not necessarily tell all this person's business. So just kind of satisfying any of those concerns for anyone who may be thinking it. And so we're gonna call this client Mary, right? And I met Mary I want to say about 3 or 4 months ago. And Mary was referred to me by one of my existing clients. And one of the reasons why one of my existing clients referred Mary to me is because in talking, my client was talking with Mary, who's their friends and whatnot. In talking with Mary, Mary was expressing a lot of just frustration and just a lot of exhaust around taxes and finances. And one of the things that was going on with Mary, she had her own business and she was doing well in business. She was doing well with her business. She was doing well with her finances. But for some reason, even though things appeared to be going well in terms of the money and revenue that she was bringing in, she still couldn't figure out why she had a large tax bill or why she couldn't understand why she wasn't being eligible for certain credits and doing all of these different things that you would think or that we're told as business owners are applicable, right? And so this frustration from Mary was really starting to get to her to the point where she wasn't even motivated or encouraged to want to grow her business even more. She was already on a good track. Like she had experienced some growth within her business in a short period of time, and that was going to continue to happen. But because she was so concerned about what that growth in revenue and growth for her business was going to do to her taxes, she was really discouraged to even kind of move forward. And so it wasn't until that point that she decided that a change needed to be made. And so at that time, when my client referred Mary to me, we had a consultation, right? And so think about some of those same frustrations, some of that same confusion that most people have as it relates to taxes, some of the avoidance that people have relating to wanting to do certain things, but then like, oh, I don't even want to deal with the headache of X, or if I'm going to make more, that means I'm going to pay more. So I don't even want to deal with that, right? I've often said that making more money is a problem that we want to have, because being able to figure out how to pay less or how to structure that money in a different way, that's just part of the process. We don't want to avoid making more money because we're afraid about paying more. And that's again a mindset shift that we want to start to have as it relates to money and our finances and our growth. So in meeting with Mary, and I'm going to share a little bit about where Mary is now and kind of the different things that we've been working on. But this kind of leads me into the strategies that I really want to touch upon and lean into on in this session, and for those that are listening, because there's a lot of different things that we can do. So I really try to narrow this down as much as possible. But also, I want everyone to keep in mind I'm going to be sharing general and slightly specific information about these different do's and don'ts. But it's really important, and I think I've mentioned this previously, it's really important to see how these strategies apply to your specific situation. The different strategies that I'm going to share, some are going to be applicable, some maybe not applicable right now, but something to move towards, going back to the strategy plan and all of that. But I really want, these aren't cookie cutter type of strategies. These aren't things that we're just throwing against the wall to see what sticks. It's really getting together with your tax advisor, your tax strategist, to say, okay, hey, this is what I'm trying to do. This is where I'm at. What can we do to get there? Type of thing. And so these help to start the conversation relating to that. These are also not in any particular order, but all valuable and beneficial. So, hopping right in, tax loss harvesting. Now, Some people may not know what that means, so let me explain. For those of us who have investments, whether that's I'll primarily stick to investments in the stock market as an example. Tax loss harvesting means that you're paying attention to your portfolio and in relation to what has been doing well and what has not been doing so well. And so as we approach the end of the year, if you're realizing, and again, as if you've been paying attention to your money and to your finances for the majority of the year, you will know whether you've been making more money than expected as relates to your investments, or if maybe you've been taking a bit of a hit in some of the investments that you have. And so tax loss harvesting means that now is the strategic time to evaluate, okay, which of these investments am I going to kind of cut the cord on and let go to be able to take advantage of the loss that I'm taking on this particular investment. So it's kind of an approach of saying, okay, I know that I'm going to use easy numbers here. I know that I paid $1,000 towards a particular amount of stocks. And now those stocks have gone down, and I'm using stocks as just an example. This can apply to many different investments. But I paid $1,000 for a certain amount of stocks. Those stocks have now gone down those stocks have gone from 800 to 700 to 600. Maybe they're only worth 500 at this point. The idea is that instead of kind of holding a tight, firm grip onto those particular investments to see if you even get back to the $1,000 that you initially invested, maybe it's time to cut that cord and say, okay, I'm going to take this $500 loss because that $500 loss is going to offset other profits or other gains that I have made in another investment. So the tax loss harvesting is you're harvesting this amount of losses that you are currently accumulating and using that to offset gains from another investment. So the idea behind this is you're saving money because instead of just keeping those losses on paper and kind of letting it either continuing to go down or maybe inch up, inch down and playing this yo-yo game, you're able to actually capture these losses and then have it offset something else. So you're paying less in the profit or the gains that you're making from another investment. So I should have prefaced this by saying I'm going to try to speak as I don't want to say simplistic, but I'm going to try to not talk shop, if you will, or talk very technical. So hopefully, what I'm saying is making sense. But from a tax loss harvesting standpoint, the idea is basically capture the losses while you have it so that it can offset other gains that you may have relating to your investments. And again, I'm not going to get specific on what those particular investments are. Let's have a strategy session and kind of work those things out. But just keep this in mind as a particular potential strategy that you can use relating to that. Next, charitable contributions. Now, I have varied views on charitable contributions, and not from the standpoint of not wanting to give back or donate. I just also want people to pay attention to donating only for the purpose of taxes. I feel we're getting into holiday season, right? This is the time for giving. This is the time to give back. So if you are already inclined to be giving to either the food pantries or the shelters or children's hospitals, all of these different places that are requesting donations, then yes, increase that if that's something that you were already going to do, because there's now a double benefit there. Now the organizations or the individuals that you are donating to benefit. And then depending on the amount that you decide to contribute, now you can potentially get a tax write-off or tax deduction associated with that as well. So my whole premise is that, I mean, do I want people to give more? Sure. But don't think, okay, I'm going to give 5,000 because I'm going to get 5,000 back on my tax return. It is not a direct dollar for dollar type of situation, right? And so that's why I say make sure that you're doing this, because this is truly something that you want to do and something that you are already going to do. Maybe we just increase that a little bit more if that's where you already are, to make sure we fill in that gap of whatever is happening. And you want to make sure that it's a qualified charitable contribution organization. Political stuff doesn't play in. So all those who've been, contributing to all of these political campaigns, and we all get the text messages from from the different candidates about, hey, don't. I mean, you can give if you want, but don't think that that's going to translate to the taxes. Anywho, I said I wasn't going to talk about political stuff. But just know that political contributions don't count as charitable contributions. But we want to make sure that if it is something that you're already doing, giving to the church, all of these different things, we can maybe increase that if it makes sense for your situation. So before the end of the year, because this does have to be done before December 31st, making sure that you're optimizing that for your particular situation, and keep track, because we need records. It's all about documentation. I should get a t-shirt or a hoodie or something that says it's all about documentation, because it is all about the paper in all aspects of taxes. It's all about the paper. Okay. Retirement contributions. Now this is a bit of a loaded one in terms of this is going to be applicable to clients that I have that have a W-2. This is going to be applicable for clients that have their own business. This is a pretty beneficial option. So for retirement contributions, I'll start with folks who are working a W-2. It always surprises me, and granted, I know that life be lifing, so we can't always donate or contribute as much as we want, right? But from a retirement contribution standpoint, if you have the ability to max out the 401k contributions that you have with your employer, max those out. For 2024, don't quote me, but I'm pretty sure that the maximum amount that you can contribute to your 401k is about $23,000. So if you have the ability to be able to contribute that, and the reason why I'm suggesting this, the reason why this is an option is because you can contribute this amount pre-tax. So what that means is that you are now going to be able to be taxed on a lower amount than what your regular income is, the more that you can contribute to a pre-tax account. And so I have retirement contributions here, and that generally falls into the 401k, the 403b, the 457s, depending on what type of organization you're working for. But your pre-tax accounts can be very beneficial, especially if you're working a W-2, because when we have a W-2, we are generally limited in some of the options that we have available relating to tax deductions. I'm not saying it's impossible, or I'm not saying that there aren't any. We just have to be even more strategic and even more I forgot the word. But anyway, we have to be more strategic and more creative. That's the word I was looking for, as it relates to finding deductions and taking advantage of deductions when we have a W-2. And so one of those options is contributing to pre-tax accounts, whether that's your retirement accounts, like I mentioned, the 401s, the 403bs, the 457s. You also have other pre-tax accounts like your HSAs. So that's a health savings account. So for those, either whether you have children or not, but especially if you have children, they're always going to the doctor and they need glasses and braces and stuff with the teeth and all of the things. And so you want to make sure, if you have the option to contribute to a health savings account, which is also a pre-tax account, you're contributing money to that account. One, because any medical related expenses that you have to pay for out of pocket, you can pay for through your health savings account. So again, now you're reducing your taxable income by being taxed on a lesser amount, because you're contributing an amount to this account before you're taxed on it. But then also it continues to roll over year after year. So you don't necessarily have to use everything by the end of the year, but you want to make sure that you're at least contributing as much as you can by the end of the year. So again, hopefully that makes sense. And because it doesn't expire when you don't use everything in there, it's just going to continue to accumulate year after year. Now, we don't want people to, have to exhaust these health savings accounts because of, um, real like tragedy emergencies or anything like that. But it's a good option to have, especially again for things that are expensive. I mean, glasses are expensive. Teeth and like dentists and all of that stuff is expensive. And so even just regular checkups are expensive. And so if you're able to get a little bit of be able to leverage more of your money and still take care of the different things that you have to do, that's the name of the game. So that's relating to HSA. So going back to retirement contributions, max out your 401ks or your retirement accounts, especially if your employers provide a match. A lot of times if you put in, and what a match is, if you put in 4%, the employer will match that 4%. And so even a lot of times people don't participate in the match because they're like, oh, well, I'm not vested and I'm not going to be there for that long. I already talked about how we're already in November of 2024. You'll be very surprised how long you end up staying at a job. Before you know it, you're there for 5 years and you could have been contributing to your retirement accounts or this 401k account for that whole time. And then now you're vested. So you basically doubled your account just from doing what you were already doing. So um, but yeah, from a contribution standpoint, try if you can to do at least up to the match, and then sometimes if you do up to the match, they add like a little bonus on top of that. So that's even better. So something to keep in mind. Now, for my clients or my folks who are listening who have businesses, and I'm also it's a lot of times I don't see this being taken advantage of enough. If you have um an LLC, or if you have a partnership or an S corp, S corporation or a C corporation, these are businesses, these are entities that you have outside of a job, or this is your business. You can create retirement accounts within your own business. So if you have an LLC, you can create a SEP IRA, which is basically like a self-employed pension plan that's associated with your business. If you have a partnership or an S corporation, you can create or even with an LLC, you can create a solo 401k, which means it's not associated with like an employer. You are your employer because you have the LLC. So a solo 401k is also something that you can create, which has to be associated with a business. That's why it's a solo 401k, as opposed to an IRA, which you can start. I'm not going to get into all the things, but an IRA is something that you can have outside of a business. So even if someone has a 401k with their business, you can have a separate IRA to be able to contribute more to your retirement. And so, touching on that really quickly, if you're contributing the max to your 401k account and you still have some additional funds that you would like to be able to put to use, you can open up an IRA. And with an IRA, depending on which kind you set up, whether it's a traditional or a Roth, um, you'll be able to contribute up to 6,000. I want to say maybe it's like 6,500 now. Sorry, I have to double check. It goes up each year for inflation, but I want to say it's at least 6,000. I know that much. I think it went up to 6,500 for 2024. And then if you're over the age of 50, it's 7,000 or 7,500. But you can contribute additional money to that type of retirement account. And if it's a traditional account, you can get a deduction on your tax return depending on how much income you make. And then if you contribute to a Roth IRA, that plays into the long-term gain that I referenced before in terms of now contributing to a Roth. the money that's in that account starts to or continues to grow tax-free, so that when you do happen to use it in retirement, now you're not paying extra taxes on that amount. And so that's one of the options as we start to put together a strategic tax plan that may be more beneficial for you in the long run, even if it does not give you a tax deduction right now, but it will pay off later. And so that's something, again, to keep in mind. Going back to the businesses that can create their own retirement account as part of the business, this is a strategic way to be able to use your business income to not have it be taxable to you, and then you're still creating a retirement account for yourself. And the limits for a solo 401k or a SEP IRA or an IRA associated with the business, which again, a SEP IRA is a self-employed pension plan, those limits are generally higher than what you can contribute with a W-2 retirement account. So again, I'm not giving specifics on what those amounts are. That's definitely something where if I'm in a consultation and we're evaluating your particular situation, we can get more into the specifics of what those numbers are, but it is at least 23,000 as a baseline of what you can contribute. And so this is how we start to shift money around based on, excuse me. Oops, excuse me. Interruption. But this is how we can start to shift money around based on, instead of you keeping all of that profit or income from your business as a lump sum and then paying taxes on it to the IRS, now you can contribute that amount to a retirement account, and now you're saving money for yourself, keeping more of the money in your pocket as opposed to giving it to taxes. So again, just a shifting or a reframing of what that looks like. So that kind of covers retirement contributions, which then leads me into business structuring. And so this is early in the year is perfect, but since we're here at towards the end of the year, this is a good time to evaluate where your business is. And what I mean by that is, a lot of times, and this kind of goes into like proper bookkeeping and having your records together and all of that. A lot of times I will meet with either clients or potential clients, and they don't realize how much they've made during the year until they look at it and they're like, oh, I mean, I know I was doing good, but I didn't know I was doing that good, type of thing. And so I actually just had a conversation. I went to Pilates, and then I was talking with the Pilates instructor, and I was saying, "Oh, I'm a tax strategist, and I have my own business." He's like, "Oh, well, I need to do some things with my taxes because I want to shift from an LLC to an S corp." And it's like, okay, well, are you? I mean, we had a quick, like, in between classes, because I did like a double, but anyway, in between classes, we were talking about just getting into a really impromptu tax conversation. And essentially, what came out of it is that he didn't realize he made as much as he did to be able to qualify to convert his LLC to an S corporation. And because of that, he wanted to make that conversion, or thought at least about trying to make that conversion to save on self-employment taxes. And so essentially what I'm saying is that if you don't realize that you made a certain amount of money when it comes, if you're not kind of doing this planning or meeting with your advisor throughout the year, when it comes to tax time, that's when the sticker shock happens of, oh, I didn't know I made this much, and now I owe this much back in taxes because I didn't strategically set myself up to be able to save on taxes. And so if you're making a certain amount of money in your business and you want to be able to um, better organize what's happening so that you can save money on taxes, maybe put yourself on payroll so that you're able to create more expenses for your business, this is the time to evaluate that. This is the time to recognize, should I be taxed as a different entity than what I'm currently operating as, because this can potentially save me on taxes down the line. And this is a really important one for the end of the year, because You want to make that application to convert your particular entity very soon rather than later. I would say even way before December 31st, because a lot of people don't realize the IRS shuts down. Like, they don't stay open 12 months of the year. Like, they will stop, accepting applications and tax returns and all of these things generally like mid-November. Or maybe right after, or right before Thanksgiving. Thanksgiving's a little bit later this year, so it may be right before Thanksgiving, and then now you have to wait until next year, January, usually after MLK weekend, to then be able to start engaging with the IRS again. And so this is a particular strategy where if you're in that situation where you either are considering or know that your business needs to be taxed as a different um, business entity in order to be able to save on taxes, now is the time to do so. But you also want to make sure that it's the right move for your business, because yeah, just because. I mean, there are certain ways that it may not benefit you. It may cost you more just in tax preparation fees and all of that, especially if the business isn't in a position to support what that business structuring entity is, then it might not make sense for you right now. We can also do things to help you get ready to be there, as well. And so another key benefit, and I'll just use the converting from an LLC to be taxed as an S corp as an example, brings me into an accountable plan. So this is one of the strategies that a couple of clients have been using, in terms of an accountable plan is strictly for S corporations or business entities that are being taxed as S corporations. And the accountable plan essentially provides an opportunity for employees or shareholders of the business to be paid back for personal expenses that they incur. So for a sole proprietor, I hear a lot of times that, well, not here, but for sole proprietors or people, who are, self-employed, you have different options in terms of being able to, um, write off home office deductions or mileage, meals, like different things like that relating to the business. We're not just writing off everything, it has to be associated with the business. But when you start being structured, or if the entity starts being taxed as a different business entity, you have to be more strategic, and you have to be more intentional, even relating to the different deductions that you can qualify for. And so an accountable plan allows, and I'm not again going to get into the specifics of how this works, but essentially, an accountable plan allows you to be able to get reimbursed from your business for the different personal expenses that are incurred, similar to how a self-employed or a sole proprietor is able to deduct those directly on their tax return. Um, Hopefully that makes sense. I'm not going to get too much into the weeds on the mechanics behind it. I can make that more specific, or get really more in depth relating to that when we have a consultation. But just understand that this is an option that is provided to businesses that are S corporations or taxes or as S corporations, to add another legitimate business expense to your bottom line, and it still benefits you in the process. So just understand it from that perspective right now. Another do, if you will, and this is also particularly for, I think it applies to all, but particularly for business owners, you want to prepay any business expenses that you have. So, towards the end of the year, I'm sure you've been seeing there's a lot of different conferences, masterminds, all of these different things relating to business. if you have the and even if it's not being held this year, so you'll see a lot of people starting to promote or market or advertise for different events that they may be holding next year. Or you'll see oftentimes, like from a marketing standpoint, if you pay ahead for like your hosting fees, or if you pay ahead for certain things relating to marketing or anything for your business, if you pay it in this year, if you pay it before December 31st of this year, you're able to deduct it in this year, even if you're not doing it until next year. So again, if we're looking for strategies or options to be able to reduce taxable income that's going to be reported on your 2024 tax return, and you have the opportunity and the ability to pay something ahead of time as it relates to your business, this is a really good option to be able to do that. Again, these are all really geared around things that you can do before the end of the year to improve your situation. So prepaying expenses, especially if they're applicable to what you're doing, is a really good one. That then takes me to unnecessary purchases. So I'm not, downplaying or putting down any of the, advice that's out there. I'm not really on TikTok, but I can see all the different stuff that's shared on TikTok, all the different strategies, pay your kids, buy the G5, all of these different things. These are sometimes unnecessary expenses for most people. And I say that because, okay, let's just take the whole car buying strategy that has been shared. And it's not to say that it's not legitimate, it just may not be applicable to your particular situation. Don't just buy a car that's over 6,000 pounds because that fits the criteria of what the deduction qualifies for, but then you don't use this car for anything. It's kind of just sitting there, just taking up space, but you bought it because you wanted to get the deduction. Okay, and then what are you going to do with it next year? And then what if you decide to sell it? Now you have to buy back. Now you have to add back all of those deductions that you took, and it kind of defeats the purpose of why you did it in the first place. So I'm just using that as an initial example in terms of unnecessary purchases, but don't, and this goes back to the charitable contributions type of thing. Don't do things just for the purposes of thinking it's going to translate into a tax deduction, because it can backfire if it's not applicable to your situation. So just keep that in mind relating to a year-end don't, because as we approach the end of the year, people kind of go on a fire sale and start doing certain things, and it may not be applicable to your particular situation. Continuing on my list, estimated payments. And so this is more so again for business owners or folks that have make high amounts on their W-2s. Making estimated payments is essentially you paying your taxes on your own during the year. And so for a business owner, especially if you're not structured, if the business is not structured in a way where you have payroll set up for your business, you want to make sure that you're paying your own taxes during the year. And let's not get this confused. Like, we're talking about how to save taxes, but at the end of the day, we are paying taxes. This webinar or the information that I'm sharing is not designed to tell you we're not paying any taxes at all. Taxes do have a benefit. Although they may be expensive sometimes, they do provide a benefit to our communities and all of those things. So it's not to say we don't want to pay any taxes at all. We just want to be strategic and leverage and be more mindful of how much we're paying. We don't want to pay extra, just want to pay our fair share. And so with that said, yes, you want to make sure that you're paying your taxes during the year. With a W-2, if you are a W-2 employee, you're paying your taxes through your paycheck, and then you're potentially getting some of that back if you're set up correctly and whatnot. But if you're a business, that doesn't eliminate you from paying taxes. Let's not necessarily listen to all of the different things. I mean, I'll throw Trump out there only because he's a general like example of this. Everybody's like, well, how doesn't he pay any taxes? One, I mean, there's a couple of reasons. I mean, how he's structured and whatever it is, but there is still taxes being paid. It's just not as much because of the way that his stuff is designed. I'll just leave it that way. But you're still paying taxes, and so you want to make sure that if you are in a position or should be in a position to pay estimated payments, that you're making those pay estimated taxes, that you're making those payments. Because if when you're filing your tax return, you have an amount owed of more than $1,000, that's when the penalties and the interest from the IRS and the states usually start to add onto your return. So you want to make sure, again, either through strategic planning and making sure that you're making payments, that doesn't apply to your situation. Oh, I didn't realize some of these are a bit heavy hitters, but okay. IRA contribution, Roth IRA contributions. This is actually a do and a don't because, oh, and I'm at time. But anyway, we're going to go a little over, so sorry. But Roth IRA contributions are a bit of a do and a don't, mainly because you do want to contribute to a Roth IRA. Again, as I mentioned previously, contributing to Roth IRAs they don't give you a deduction on the tax return, but they do provide benefits for you down the line. The reason why I say it's a don't is because depending on how much income you make, some people can't directly contribute to a Roth IRA, so they have to contribute to a traditional IRA first, and then you can strategically convert some of that or some of the money that's in the traditional IRA to a Roth IRA. The reason why I say it's a don't is that you want to make sure you're paying attention to how much you're converting at one time, because when you're contributing money when you're converting money from a traditional IRA to a Roth IRA, that does create a taxable event. So I put this more so on the list because if you're in a position where you're more concerned or paying more attention to what you're going to do for the long term, you may make the mistake of converting everything that you have in a traditional IRA to a Roth IRA and creating an even larger tax bill for yourself, as opposed to breaking up the amounts that you're converting over time. So the tax hit isn't as much as if you converted everything. So again, that's kind of a back door that I put there. You go to a traditional first, and then you convert it to a Roth, and it's like a backdoor way of converting to a Roth IRA. Again, that's a little bit of an advanced strategy, but I figured I'd put it in there because I do think it's applicable to some of the folks either on or who would be listening. So again, that goes in the do and don't category, but pay attention to the don't part because that could really affect you if it's not done correctly. And then lastly, well, for this list anyway, is adjusting withholdings. Now, I also want this is a do and don't um, as well, because it's a do in the sense that going back to what I was mentioning about not wanting to necessarily give the IRS or the state an interest-free loan, adjusting your withholdings so that, okay, maybe if you're filing zero, maybe towards the end of the year, you switch it to one. So you balance yourself out in terms of the amount of taxes that you're paying. The reason why this is a potential don't is because if you already weren't filing the correct withholdings from the first place, you don't want to go making adjustments to make that situation even worse towards the end of the year. And I know a lot of times, I have clients or people that I've spoken with that will adjust those withholdings towards the end of the year, because what happens at the end of the year? You get bonuses, right? And a lot of times those bonuses are included with your pay, and you don't want a bulk of your bonus going to taxes. I totally get it. And so that's when we strategically say, okay, let's wait till this month or whatever it is to adjust your withholdings. But again, if you weren't right from the beginning, don't go making changes. It's going to make the situation even worse, because it's either you pay taxes now or you pay taxes later, or you figure out the nice balance in between. The other thing that I want to mention about adjusting withholdings is really kind of geared towards couples or more married couples and couples who are filing jointly. Because what I've also noticed is that you'll have the both of the married people, and maybe both of you are doing married zero, right? And so there has to be a nice balance, especially with the way that the tax code has changed recently. Maybe we're adjusting so that one person is filing single just from a paperwork standpoint, and the other person is filing married. So you're kind of balancing out the amount of taxes that's being paid. That's one of the adjustments that's a do, where again, that's more specific to every person's situation, but that's definitely something to pay attention to, because sometimes if you're both filing married, and depending on how much money you're making, there may not be enough taxes paid on the whole amount when both of your incomes come together to file as a joint tax return. So that's another thing to pay attention to relating to adjusting withholdings. All right. That was a lot. I kind of went over in my time. But I think that this is all hopefully all, beneficial and things that kind of start the conversation as it relates to tax strategies that you can do for the end of the year. So I mean, this is enough to keep y'all busy for like the next, 6 weeks or whatever else we have left in the year. So happy to speak more specifically with anyone relating to that. And so that kind of brings me back to Mary, right? So we're back with Mary, like we had our consultation. And again, this was not an exhaustive list of the different strategies that are available, but we kind of really dug deep into what was happening with Mary, what was going on with her situation. We got her set up with an accountable plan. We made sure that she was filing or paying taxes through her business. We're making sure that she was optimizing her deductions. So we paid attention to the different things. She got set up with health insurance, which is another business deduction that is applicable, relating to making sure that that gets done before the end of the year. She prepaid for her like tax strategy services, so she can make sure that she can take that as like a deduction in the 1 year before the end of the year. So all of these different things, again, it's just touching upon some of the different strategies that I went over, we were able to leverage because we were proactive in saying, okay, what's going on? What are you trying to do? How can we help you get there? And that's how we improved Mary's situation. So now it's not so much of a headache when it comes to taxes. More like, okay, well, let me meet with Lorraine to see if I can do X. Like it's more of a, again, like an excitement of, well, maybe excitement might be a stretch, but anyway, it's more of a it's not so much of a burden in terms of getting together and talking about tax stuff, because it's more empowering to find out what can we do versus how much do I owe now type of conversation. So everyone who's wanting to achieve that same thing, or not necessarily realizing that that's the direction we should all be going into, now's the time to start putting those things into place. All right, so that's part of the strategic tax action plan. Like it's an action plan because we're going to work, we're doing things, we're making sure that we're putting stuff where it needs to go, and all of those different things. And it's again more of a tailored approach to your particular situation. I can give all of the different things, what fits for you. And so understanding how to uncover these specific tax strategies and deductions that maybe you didn't know were applicable, or that were even available to you, that you can now take advantage of. And again, getting proactive with the planning. We're not reactive to these things of saying, oh, well, better luck next year type of thing. We're being proactive relating to this, and we're putting this plan together, so that again, even if it's everything is not happening at once right now, we know what we're working towards. And so that's helping to unlock your full financial potential. We talked about financial freedom, location freedom, time freedom. it's all around your financial health and what that looks like, because who wants to be stressed? We're too blessed to be stressed. I had to throw that in there. It's just, it just fits, right? Along with everything. And so for all those who, are these hopefully these things are kind of like an eye opener, or hopefully the information that I shared is starting to shift your mindset around, okay, maybe I need to talk to Lorraine outside of January to April. Like maybe I need to talk to her, or December, because sometimes, but anyway, like I need to talk to her outside of just that time when we're filing the tax. Like we need to have some conversations and ongoing conversations. And that's really what the strategic approach and having a tax advisor on your side means. And so I've sent out information to my clients, and maybe there's some folks on here who are not my client yet, or who will be listening who aren't my client. We need to have year-end consultations. Like I know I send the information out, and sometimes people are like, oh, well, nothing changed, or I don't really have much to ask or talk about, and so we don't meet. This was an opportunity to kind of like give you some ideas of different things that you didn't maybe recognize were going on, that are actually applicable, or that could be helpful to your situation. So schedule the year-end consultation, where I think again, like 8 weeks, but then I'm taking Christmas off, so we're not even counting that. So we basically got like 4 6 weeks to get these meetings in, so that we can really start putting the plan together, or see what we can do to help out before the end of the year. So I really encourage everyone to schedule some time, get on the calendar. Calendar fills up, I'm not just saying that, the calendar fills up. So let's make sure that we get those meetings in. And so before I get to the link, I wanted to remind everyone, I believe I sent this out to everyone, but I just wanted to remind everyone that I will be speaking live on a lot of the information that I shared today, but kind of expanding upon that. And it will be focused on year-end stuff, but it's also on like other tax optimization strategies that don't necessarily have to be done before the end of the year, but that can really help your situation if you start to put it into place now. So I'm going to be going more in depth on tax optimization strategies, but we're really also going to be touching on wealth mindset and how to build and establish and empower your wealth mindset. Did I lose? Hopefully you can still hear me. I don't know. Yeah, okay. So, so I'm going to be I'm speaking live at a conference in November. It's a 3-day conference where we're getting into all things money. There will be other presenters there as well that are going into different topics as well. So it's really a holistic weekend around business and improvement, to really set you up for going into 2025, and to really end this year strong. But if you want to hear more about the tax optimization strategies, kind of pick my brain a little bit more, but then also really start to interruption. Sorry, hold on. Okay. Really start to lean into where your mindset is as it relates to money, because how we think about money really affects how we make it, how we multiply it, how we grow it, all of that, right? And so we really need to tap into where is your mindset around money, and how can we better start to shift you to get to where you want to be. Excuse me. What happens when you talk too much? Okay, hold on. Interruption. Okay. Okay, I'm back. So for all those who are listening here who are in New York, I know I have some clients who are outside of state, Atlanta, all the other places. If this is Veterans Day weekend, so you can fly in. Unfortunately, it's not available virtually. It's only in person. So I think it's going to be really beneficial, and it's going to really, set you on the right track. And then I'll be there. So, I mean, that's an extra bonus. So for anyone who's interested in attending, There was a promotion. It's not available anymore, unfortunately. But if you're interested in going, reach out to me and let's see if we can figure out something if you really want to attend in person. But just wanted to give a reminder about this. And then for all of those who are interested in scheduling your strategy session so we can really get in depth relating to your situation, how everything that I shared tonight might be applicable, and even more that I didn't share that may be applicable for your situation. Use this QR code. I hope it works. Again, I do taxes. I don't do PowerPoint, so hopefully it works. It should work. But make sure that you schedule your year-end consultations with me. And if you have any questions, feel free to reach out. Oh, I should have put my website on here. Well, it's melanintax.com. So my email is basically Lorraine@melanintax.com. I should have probably had that on the screen. But anywho, you can reach out to me if you have questions or if you want to better understand what the strategy session can do for you. But it's something that I think everyone should invest in if you want to improve your situation. And me being 15 minutes over, I'm going to stop here. I think during the presentation I saw stuff in the chat, but I don't know. Hold on. I don't know if there were any questions. I've been doing okay. Makes sense. Prepay. Different trusts. Oh, sorry, I'm just reading through the question. So if anyone is here and wants to ask anything while I'm going through the questions, feel free to come off mute. And then, oh, thanks, Melvin. Okay, he said he had to jump off. Okay. Let's say so. Okay, if no one has any questions, I think we'll leave. Let me look at yours. So, are you familiar with the different trusts? I know that lawyers set them up, but should be consult. Uh-huh. Yeah. So, there, and I'm not a lawyer, but for sure, depending on what your objective is for setting up the trust, a lot of times it's for anonymity purposes. It's generally and more for estate planning purposes, but it doesn't necessarily give you a like a deduction or a tax advantage right now. Again, I'm not saying that it's not beneficial. It's just that you want to make sure about what kind of trust you're setting up. Usually speaking, it's a irrevocable or a revocable living trust, I think is the one that you want, because then you still have control over your assets. But then depending on what you're putting into that revocable trust, let's just say, for example, you're putting a rental property in that revocable trust. If that rental property is generating income, the revocable trusts have like a low threshold. So I think if you're making, or if that asset makes more than like, and don't quote me, but I feel like it's like 13,000, 15,000, something like that, then now you're paying taxes on that, and um that's at a higher income tax or a higher taxable rate than if you just had it as part of your regular income tax. So that's definitely something that we can talk about more specifically, more so around what is your intention for wanting to do the trust, and what kind of assets are going in that type of structure or in that type of entity. So hopefully that helps. Um, Thank you, Talitha. I appreciate that. Um, Thank you, Tanya. Yes, I'm really happy everyone was able to join. Um, Thank you, Paulette. Let me see if I have. Um, okay. Okay, I'm glad. I'm glad, Yvette. Oh no, please, you were fine. I was trying to multitask between letting folks in and then also staying on task. And I again went a little bit over, but I appreciate everyone staying. Again, really hope all of the information was helpful. And again, this kind of just scratches the surface. Like I didn't get into too many like advanced strategies. I mean, I will do a little bit more of that in the presentation in November. But yeah, like we can definitely talk one-on-one relating to a lot of the advanced strategies as well. Sorry. All this, I don't know. Just kind of anyway. So want to be now I want to be respectful of everyone's time. But now that I kind of got to the end of the presentation, if there if no one has any questions, again, feel free to reach out to me. If you have any questions, I can put, I think everyone has my contact information, but if not, let me put my website in the chat, and then let me just put my email. But I'm really hoping that, everyone schedules a session. Like let's kind of get into get really in depth relating to what's going on, and see at least if we can do if we can do at least one of these before the end of the year, I think it'll make, a good difference in what's happening. And then that again just sets the stage for what we continue to build upon. So with that, thanks again all for joining. Have a great, oh, thank you, Jason. Thanks for joining. But what was I saying? I get so distracted. Squirrel. Anyway, but thank you everyone for joining. Looking forward to seeing you in some upcoming strategy sessions. This was recorded, so again, thanks for that reminder. So I will be sending that out to everyone who's on and everyone who registered. And have a great rest of the night and your weekend. Thank you, Paulette. Thank you all for joining. Bye.